In this video, we're going to talk about Hyliion, trading under the ticker symbol HYLN. At the moment, the financial market is very volatile, and we have to be careful about which stocks to buy, as well as the exposure and timing of our trades. This video is going to cover the recent price actions and the technical aspects of the stock. Before the video begins, a quick heads up that my analysis is based on sessions that are already completed, and that it may not take into consideration the latest events. If that's the case, I'm going to make up follow-up videos to reflect them. With that being said, let's begin with today's topic. During the most recent trading session, the stock decreased to $3.89 before closing the trading day at $3.95. We should pay attention to the $4 level nearby because it was tested multiple times as a support level ever since January of this year, which is quite impressive for such a bearish stock. Over the past 30 days, the trend of the stock has been holding quite firmly near the $4 level, so I would say that it's more closer to like bottoming, even if sometimes it dips a bit below, but it tends to come back quickly afterwards. From the perspective of a longer time frame, which is 6 months and above, the trend of the stock has been bearish since the stock lost a very significant chunk of its value over the course of that period. When we look at the price trend overall, it's been slowing down. I would say that the bearish trend has been slowing down and potentially reversing from there, from the obviously bearish tendencies recently. The trading volume of Hyliion has recently been 1.5 million shares versus the average volume of 2.2 million shares. So in other words, it's not trading that much, although given the price action, this is actually quite good news, meaning the upside is huge. Over the previous 52-week period, its price fluctuated between $3.33 and $14.80. The market cap of Hyliion is currently at $677 million versus the enterprise value of $706 million. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or has a negative image amongst the market participants, the assets value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statements, so it is relatively less reactive than the market cap and often more lenient for some types of companies as well. One key element to note regarding the enterprise value is that for many growth-type corporations, one of the most significant assets they own is the goodwill. Goodwill is an expectation of the market that the company is able to generate more profit or to have more growth than other companies, partially because it may have a good management, a stronger brand recognition, or a bigger online following. It is what makes this company in particular unique compared to alternative competitors. In other words, it's not a tangible asset that companies may use, but it's often the reason why some companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value, or the enterprise value is less reactive than the market cap in very volatile situations. If the company goes to liquidation, though, there won't be any goodwill left, and we would be left potentially less assets to distribute amongst the shareholders and debt holders than the number we see on a balance sheet. When we compare the current price to its historical price fluctuations, the stock is 17% higher than the 1-month low, 17% higher than the 3-month low, and 17% higher than the 52-week low. On the options market, which gives us a hint on the market sentiment about where the stock price is going to go next, the implied volatility is 96% versus a historical volatility of 89%. The put-call volume ratio is currently at 0.27. It is normal for most stocks to have a higher put option volume than what they deserve, since many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 1.2 thousand contracts a day, versus the 30-day average of 2,000. In terms of open interest, the most recent volume of open interest is 26,000 contracts versus the 30-day average of 37,000 contracts. In terms of shareholder structure, institutional owners have about 30% of the outstanding float. The biggest shareholders include Vanguard, BlackRock, and State Street. It's relevant to understand the shareholder composition of a company because it helps to determine if you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, this can potentially be a sign that the stock may lack the depth to justify long-term trust from shareholders. The consensus at the moment is that there should be about 25 to 30% of institutional participation at least for the stock to be perceived as a good investment and not just a short-term trade. There's a lot of exceptions to this since many great titles are also mostly held by retail investors, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price goes lower. Sometimes there can be significant short interest in the total volume. This can be a sign that there's an organized shorting operation going on, like what is going on with GameStop and AMC. The current short interest is 16% of the total floats and 51% of the transactions coming out of the dark pool. Overall, my opinion on Hyliion is cautiously bullish and start to believe that we can expect an entry point for the short term, or even now, if the risk profile fits you. The maximum exposure I would recommend is 1 to 3% of your portfolio. And for the immediate term, my recommendation is to buy the stock, considering the recent price actions and the promising price levels that are close to where the stock is right now. I would recommend to separate the allocation to batches of 25% at a time so that you can have enough room for later purchases. In the current market environment, I think that we should be careful about taking positions in the financial market in general, especially when it comes to equity market. Over the past decade or so, the financial market has been living with the help of newly created capital from the quantitative easings, which resulted in the increase of asset prices and the corresponding collapse of their yields. Of course, the low interest rate also contributed to reinforce that phenomenon because the financial sector would first of all see its profit margin squeezed, which will in turn keep the returns of other sectors low as well. At the same time, the market doesn't represent the real economy, and the real economy often doesn't get reflected in the prices of their own securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. And I want to say that fundamentals sometimes doesn't play that much of a role at all. If the asset prices only depend on the fundamentals, then their performances in Northern Hemisphere would have been more than mediocre, because things have mostly been stagnant over the years, ever since the last economic recession. A few things can explain why asset prices managed to remain high during these years, despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their local economies. But because that money is distributed to banks and expected to be loaned to businesses, and that there aren't that many opportunities in the real world, the money went into the financial sector to buy up assets. Of course, the QEs are wrapping up in many countries, so for the next couple of years, it's not going to be the main driving force to keep the asset price high. But it's compensated by the arrival of new capital from different regions in North America because it's still perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be a sustained phenomenon over the years to come. The last phenomenon is the creation of artificial bubbles that are either supported by the real market trends or completely fictional to allow market participants to play the game of hot potato and to either generate profit or to safekeep their capital. Of course, the people who end up with the hot potato lose money, but that's another story. The EV sector in 2020 is an excellent example of this. Nevertheless, What it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially in Asia. This means that the market is expected to see its volatility increasing over time, which will provide opportunities to make a profit or to incur losses depending on the timing and risk management of those portfolios. Another thing to note for this period of time is to be very careful with having short positions. Usually, it's already more risky than having long positions because losses are not limited. And with the increased involvement of retail traders, I believe that the stocks being shorted will have a higher probability of getting squeezed, and this will occur randomly, which will result in potentially massive losses. We're also observing very often people will choose to rush in positions not necessarily because the fundamentals are convincing, but because there is a buildup of demand in a specific stock and that people will pile in to ride the gravy train with the rest of us. This kind of behavior is highly risky and may result in heavy losses as well. It's worth pointing out that in 2020 and probably in 2021 as well, the financial market has never presented that many opportunities, but it's also during this period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. The positions should also begin small so that there is an opportunity to average down later. Typically, the growth stocks would take about 5 to 10% in my portfolio overall, and each and every one of them represents maximum 1% of my portfolio. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.